Hi, welcome to this video day, which is all about Forex market structure and trading it for profit. What sort of strategy should you use? How do Forex prices really move? What I want to do today is just basically go through a strategy of one of the great traders, which you can use to make money in the markets. The trader will be familiar, I think, to most people watching this video. His name is George Soros, and we're just going to be looking at his theory of reflexivity. Now, it's just going to be a brief introduction. If you want more details on George Soros and all the other great traders and the techniques they use, simply join our free mailing list beneath this video. Now, in terms of Forex market structure, if you look it up online, you'll find actually that most people who teach it just simply do not understand how Forex prices move. They see the Forex markets, and I'm going to use a scientific term here, as a simple linear system. I'll explain what that means in a moment. They therefore make their analysis too complicated. They go too far back, drawing intricate patterns. They're trying to predict what will happen next, and that is doomed to failure. Now, in terms of the paradox of trading Forex market structure, it's this. Forex markets are actually a complex, adaptive system. And if you are trading the Forex markets, you need to keep your trading extremely simple, not try and predict, but basically just respond to the reality of price change, okay? Now, what I want to do is just give you a quick summary of the difference between a simple linear system and a complex adaptive system. It's just coming up on the storyboard. And when scientists refer to complex adaptive systems, they refer to the parts as agents, okay? Obviously, the agents in this example are Forex traders. Now, just take a quick look at the summary. If there's some terminology in it you don't understand, I'll explain it in more detail. Then we'll look at some techniques that are simple, that'll work and will make you money in the Forex markets. Welcome back after that short summary there of the two systems. Now, in terms of a linear system, it's easy to understand because the parts that make up the whole, okay, all perform a certain role consistently. So just think of your computer. If it breaks down, you get an engineer in and he can work out the problem and fix it. Forex markets are not like that, okay? What you have is a huge amount of traders, all with different levels of experience, different aims and objectives, making up the whole. And it's very difficult to actually predict what they're going to do. In fact, it's impossible, but it doesn't mean you can't make money. Now, in that little summary there, I've referred to feedback loops, imitation, and basically fat tail distribution. Now, what does that mean? Well, what it basically means is that traders, when they're trading the markets, create feedback loops which push prices too far. Now, how do they do this? Okay, because understanding how they do this is a key to making money. What happens is, let's say a trader wants to buy a currency, he buys it, then it goes up. He might then respond to his emotions and buy more. Then that currency will be in the news, it'll be all over the media saying it's going up forever. And more traders will want to get in on the action. That's imitation, obviously the herding instinct coming into play. What you very often find is a currency will just suddenly spike away to the upside, okay, or to the downside. And then when the news is at its most bullish or bearish, the price moves the other way, okay? What you've effectively got is traders reacting to the biases within them, okay, let's say of greed or of fear. They just push prices too far. Now, a fat tail distribution is when prices really deviate too far and you get a crash. Obviously, you see it in the stock market to lesser degrees. You see it in the Forex markets as well. If you look back on any price chart, you'll always see the big price spikes fade. Now, in terms of George Soros, he was probably the first person in finance to really realize, Forex market structure, how prices really moved. And his theory of reflexivity is highly influential. Just going to summarize it very quickly. Then I'm going to go through how you can adapt it and make money with it. So here's the quick summary. It's about 1.5 minutes. Then we're back to discuss in more detail. I will come back after that short summary there on George Soros's thinking and his theory of reflexivity. And if you think about it, how often do you see everyone really bullish about a currency or bearish, and then when the news is at its most bullish or bearish, prices go the other way? You see it all the time, okay? Now, in terms of why that happens, it's feedback loops, imitation, greed or fear pushes prices too far, then you get the reaction. Now, in terms of Soros's thinking, technical analysis is very limited. It is. If you think that market structure is about pretty patterns, intricacy, predicting and going backwards, you'll find out in the real world it doesn't work. Most of the patterns are only visible in hindsight. If you want to use just pure technical analysis, you want to keep it very, very simple and just react to price change. Okay? Don't try and predict it. Now, in terms of if you want to make really big money from the Forex markets, I would strongly advise that you look at the sentiment towards the fundamentals behind the chart. That's what the great traders do today, the ones that are making the really big money. But you might be thinking, well, how can I do that? That sounds like it needs a lot of practice and so forth. Well, yes, it does actually, but there's a shortcut way of doing it. And the shortcut way of doing it And anyone can do it with this indicator. It's called the COT, Commitment to Traders Report. It's free from the CFTC, and it will help you measure how bullish or bearish a currency pair has become. Then it will help you detect an entry, okay, where you can go against prices that have shot too far to the upside or downside. And even better, it can give you an idea of how far prices might go. Now, there's an introductory video on it beneath this one. If you go and take a look at it, you'll see why it is such a fantastic tool. We've been using it for years. We never trade without the Commitment of Traders report to back up our view. And it is a fantastic tool because you just get a shortcut to measuring the sentiment towards the fundamentals. Then you use very simple technical analysis, and then you can get some great high probability trades. Now, in terms of this video, I'm only briefly introducing Soros's theory of reflexivity and how he sees the market structure. And the way he sees it is correct in my view. Most great traders probably accept his view today. If you look at all the great traders who are making money, they all see the markets as a complex adaptive system, not a simple linear one. To learn more, as I said, about the theory and also the techniques for other great traders, click on the link beneath this video. Also, check out the COT indicator, the video introduction we put beneath this one as well. Explore it more and you'll find it's just such a great tool. And also we do a lot of COT trading on this channel, and also you can get some more videos on our free mailing list. So that's the video for today. Thank you very much for watching me. Take care. Have a good day.